In today's episode, I'm going to teach you how to trade using MACD crossovers as your buy and sell signals. Now, if you're not already using the MACD in your trading, MACD is an acronym that stands for Moving Average Convergence Divergence. And it's a technical indicator that's an oscillator, which means it's going up and down all day long. As moving averages are diverging, the MACD is going up, and as they're converging, the MACD comes back down. Now, I use the MACD every day in my trading, and today is an example where using the MACD, I was able to lock up a profit of $56,789.66. So this is an indicator you have to pay attention to, and this is a setup that you're gonna wanna learn. Now, let me introduce myself. My name is Ross Cameron. I'm a full-time trader. I funded my first account in 2001, more than 20 years ago, and I want you to know that my results are not typical. When I upload episodes like this, my goal is that you're able to piggyback off all of my years of experience, which has given me educated intuition. When I look at a chart, I see the price, I see all the technical indicators, and all of a sudden I have context. I understand the position that the price currently is in, and I'm able to make a prediction of what I think is going to happen next. And I'm right most of the time, 65, 75% accuracy, generally speaking. So what I want for you is that by the end of this episode, you're able to walk away with some tips and tricks that you can implement in your own trading starting today. So these are the topics that we're gonna cover in today's class. We're gonna begin by just talking about when this setup works, because something that's important to know is that the MACD crossover, while it's a very valid signal for buying and selling on certain types of stocks, on other stocks, it's more or less meaningless. So you need to be able to know if the stock that you're looking at in that given moment is the type of stock that the MACD is going to work on. Number two, you need to be able to identify indicators of a potential MACD crossover. I'm going to share with you the type of stocks that I like to trade MACD crossovers on, and I'm going to show you exactly where to buy and where to sell. At the end of this episode, I'll also share with you some next steps to continue learning. I'll give you some reading recommendations. You could do audiobooks, things like that, for those of you guys that just want to fully immerse yourself in learning everything you can about the market. Now, let's begin this episode with a little quiz. We did the same thing in my last episode that I uploaded, and I saw in the comments that you guys really enjoyed the quiz. So let me ask you this question. Is this right here a safe entry? Well, we have a stock. This is our technical chart. So technical analysis is giving us a pattern where we've had a nice rise up, a little pullback, another rise higher, a little pullback, a move higher, a pullback, a move higher, a pullback. So the pattern sort of at first glance might indicate that we're moving in this sort of waving formation. So buying dips has been working. However, if you said that this is an entry, you would be dead wrong. The MACD had just crossed over and you missed it. I can't believe you missed it because this is literally the topic of today's class. Look at the MACD. It had just crossed over right here. So if we have a MACD crossover, that is a high likelihood, it's an indicator that the trend is shifting. So what's happened here is if we look at the MACD on sort of break down exactly what it is, the MACD is comparing the relationship of two moving averages. It compares the 12 and the 26. So the 12 period moving average is going to be the average price over the last 12 candles. So if the price is all the way up here, the average price over the last 12 candles is going to be trailing a bit behind, right? And it's going to be trailing a bit behind this and trailing a bit behind this. And so when you connect all these dots, what you end up having is a moving average that trails slightly behind the current price. Now, the 26 moving average is going to trail even further behind the current price, but it will start to move up. And so the MACD is comparing the relationship when these two moving averages are either diverging, where they're moving apart, or where they're coming back together and squeezing. And so when they're moving apart, that's when a stock is typically moving very quickly. We've got some really strong momentum. And if they continue to stay apart, the stock is continuing to trend higher. But once those moving averages begin to converge, they're telling us that the stock is beginning to go sideways. Now, on the one hand, while you might think you could interpret that just by looking at the chart, I find it really helpful to use the MACD because in a sense, for me, it's as close as I can get to a red light or a green light. It's a red light for me to trade when the MACD is negative. This actually goes red right down here. You can very clearly see the MACD is negative. I should not be trading this to the long side. But when it's positive, that's when I would be interested. Now, of course, first, we have to decide whether or not this is even a stock worth considering, but let's just assume we've already done all of that, and it is. Now, through this episode, I'll share with you my criteria for the type of stocks I want to trade. So now let's look at the next setup. That was SNTI, MACD crossed over to the negative, and it failed. So now we have one similar pattern. This is a very strong stock. A big move here from 5, and it squeezed all the way up to about 10, pulled back, went up to $14 a share. It's dipped down here, and what do you think is going to happen next? Well, you probably noticed immediately that the MACD has gone negative and are going to say that this is a stock that I should not take an entry on right here to the long side, and you would be right. It did pop up just for a moment, but that is actually a trap where beginner traders got caught, and they end up losing money because the MACD had crossed over, the trend had already begun to shift. All right, so now let's look at the next one. So this one you're saying easy. This is easy. It's definitely a buy. The MACD is open. Wow, wrong again. Okay, so what's happening here? Here we have high volume selling. All right, so if you have high volume selling, this is also an indicator that the stock is not going to go higher. So there are two things that I check. The first is the volume, and the second is the MACD. So this is the MACD panel. The MACD has to be positive, but the volume also has to support a trade. The volume can take the form of what we call a profile. So when you've got a lot of buying volume, that's a positive profile. You could tell that a lot of people are buying the stock, they really like it. But in this case, you have one candle of green volume and then the rest are red, so that's not a setup I would take. Now, what about this? Okay, so in this case, we've got a positive MACD and we've got a decent volume profile. So it's safe to say that this looks pretty clean. And in fact, it is. Light volume pullback, nice rally back up. What about this? Once again, positive MACD, nice little pullback, decent volume profile. This is an entry that we would like. So we like all of these. But the crossover, the MACD crossover, this is a little different. Now, typically when I'm trading, when we're talking about whether or not I should buy the first pullback right in this area here, is that a pullback that we should be buying? Now, as it happened right there, let's pretend you can't see any of this. If you couldn't see any of this, what would you be looking at? You'd be looking at the MACD, which is positive, and you'd be looking at the volume. Now, in this case, you actually do have a slightly higher volume red candle, which is not ideal. So this might actually be a little bit risky right in there. But nonetheless, let's say you decide not to trade it because a little bit risky right there. That'd be fine, but this is sort of where we would evaluate taking our first trade. MACD and volume. So it ends up rallying up here, but then it pulls back and it goes sideways. So right in here, we end up getting a MACD crossover. So what I pay really close attention to is a stock that has already made a big move. And this one certainly has. It made this big move rallying from down here all the way up to here. And then it pulled back and it had the chance to completely die. The stock could have gone all the way back down to where it came from. And sometimes they do. A full round trip, so to speak. That's what we sometimes call it. But it's not dying. It's holding up. And although that seems like setting the bar very low for a stock being strong, that it's not dead, it's actually significant because the stock could have easily failed, but it's not. Buyers are still willing to buy it up at this level. And so what I look at in this type of setup is that the stock is holding up and the moving averages are beginning to converge, right? So they were diverged. They actually pulled apart to the negative, but now they're coming back together. And if we get a crossover, then all of a sudden we had that first MACD crossover. The first one here, positive, big swing. We went negative, big swing, another big swing to the upside, and we could get a nice move. And that's exactly what happened. This went from $8 a share right here all the way to 10. And I think this caught some short sellers by surprise. They might have looked at this and thought, the MACD's negative. You know, there's a little bit of selling here early. It's going to roll over. And it went below the volume weighted average price, which is a technical indicator that represents the equilibrium price of a stock over the course of the day. It's like a moving average, but it factors in volume. So when a stock is below VWAP, it's inherently bearish. And when it's above VWAP, it's inherently bullish. So a short seller is going to want to trade a stock as it breaks the VWAP going down. And they're going to keep adding. And what they look for is for it to keep unwinding. And so when they get short here and then suddenly it reclaims VWAP here, especially when it's on higher volume, that's a problem. Then it goes back below VWAP again, but it bounces back up again, once again on higher volume, and again on higher volume. So now in this little area here, we have a volume profile that's painting a picture of accumulation. People are buying at this equilibrium point. And if people are buying at this level on a stock that's already up 150% on breaking news, and it's a biotech stock, that tells us that big money is liking this setup. And so now, where is a short seller going to put their stop? Maybe they'll put it at the high of this little level right here, and they'd almost certainly put it at the high of day. They might put it at the high of this candle here. And so when all of a sudden this starts to pop, shorts are forced to cover and longs jump in because now we've got a stock that's already the leading percentage gainer on the day and it's making another move higher. So suddenly people jump on it and you get this explosive move. In a sense, it's a little bit of a surprise for some people, but I saw it coming and I was just before that candle formed, right here off of VWAP, and that gave me $53,000 in profit. This is a really solid trade. Okay, so when does this setup work? This setup only works on certain types of stocks. Why is that? Well, we have to understand the reason why this setup works. It works because as the stock begins to move up, traders quickly jump on the momentum. So when we look at this stock, we already know that this stock was up over 100% on the day when it was sitting here just going sideways. And what that means is that almost every trader out there who's on Robinhood, who's on Webull, who's on Thinkorswim, they log in on their phone and one of the first things they see are the leading percentage gainers. You see the leading percentage gainers and the broker wants you to see them. Why does the broker want you to see those stocks? Remember, you are the commodity at these brokers. They make money when you trade. So they want to encourage you to trade. It's the payment for order flow business model. So the more you trade, the more shares you trade, the more money you trade, the more money they make. And this is $1 billion business. So they're kind of subtly always hinting and pushing, these are stocks that are moving. This is how you trade. This is where you buy. This is where you sell. They want you to trade. So all of a sudden, people are logging in, seeing this stock being the leading #1 gainer in the entire market. And that creates a sense of FOMO. It's like, oh, shoot, I missed this move. I can't believe it. This thing's up 120%. I didn't even get a single trade on it. So now they're just watching it. And what are they waiting for? Well, they're waiting for it to start to move. Most people aren't going to buy a stock when it's just sort of going sideways. We don't make money doing that. So why expose ourselves to the risk of just holding when it's going sideways? Because it could, just sort of start to fade and sell off and then you lose money. So people like to trade when it's moving. That's why you see high volume come out when a stock is moving quickly and the volume tapers as it's going sideways. So I don't like to hold during sideways consolidation. I like to buy basically at breakouts, which means I have to get really good at being able to predict when the breakout's going to happen. And I've gotten pretty good at it. So good that my trade average hold time is only about 5 minutes long. So I know usually the exact apex point where I want to be buying. The price where if this breaks, it's going to go. And if it doesn't go, then I'm out right away because the trade failed. So it's like breakout or bailout, almost instant resolution. Now that was always attractive to me when I was trading earlier in my career because I couldn't afford to just sit in a position holding it for a long time, especially when I was trading on leverage and using margin. I needed to be really dialed in about getting in and getting out. Entry, exit, boom, don't overstay your welcome. Okay, so if we go back to this slide, when does this setup work? It only works on certain types of stocks. And the reason it works is because as the stock begins to move, traders jump on quickly. So traders will only jump on a stock that's already proven that it can move big, right? They're not going to jump on a stock that's having a MACD crossover that's only up 1% on the day. So therefore, it is absolutely essential that the stock is in the top 5 leading percentage gainers in the market. So I actually had said so sorry, this is a typo here, but it's essential. All right, essential that the stock is in the top 5% leading gainers in the market. It needs a lot of traders watching it in order for it to get that big breakout. Now, I'm going to put a link. It's going to be pinned at the top of the comments and in the description where you guys can download my stock selection PDF. You can download it, you can print it out, tack it or tape it to one of your monitors, and you should use that as a reference and always ask yourself before you take a trade, is this the right type of stock to trade? Now, my stock selection PDF quantifies the right type of stock for the strategy that I trade. I am a momentum trader focusing specifically on small cap stocks. That's not going to be a strategy that everyone trades, but that's the strategy that I've been trading for for all of these years. And if you're curious about whether or not the strategy works for me, it does work really well. I mean, of course, you could see from my profits today, but just sort of big picture, today's only one day. If we step back and we look at, let's just say, we could look at the last few months. So last 30 days, I'm up $634,000. $634,000 in just the last 30 days. Now, I'll say, as always, my results aren't typical. I have been doing this for a long time, but I'm pretty good at choosing the right stocks to trade each day. And my stock selection PDF is not based on opinion of what I think I'm good at. It's actually based on all of my historical data of the type of stocks I actually perform the best on. So all of this data here, this is tens of thousands of trades of data totaling over $14 million in gross profit. And all the data behind these trades and this profit, I've used to create my stock selection criteria. So I encourage you guys to download that PDF, print it out, and use it as a resource. It's totally free. So this is the profile that I was using today. Now, the profile that I use on any given day can vary slightly depending on current market conditions. So the first thing was I needed to look for a stock that was already up 30% on the day. If a stock was not up already 30% on the day, to me, it wasn't even worth looking at. So the way I figured that is I use my scanners right here. This is the Day Trade Dash software that I began developing in 2017 with a team of developers. And so I've customized this to look specifically for the type of stocks that I like to trade. And so all of my historical data has also been programmed into these scanners. And so when I first sat down, we didn't have a ton of really, really nice gappers, stocks that are opening higher than the previous day. So I was sitting pretty patiently just waiting for something to start to pop up. But actually the first trade I ended up taking was on PRTG. And when I first traded PRTG, it was at 7 a.m. Now what happened at 7 a.m. was this company came out with news. They had a letter of intent with this other company to make an acquisition. So that's a big headline. Is obviously the market responded well to it. And so when this stock started popping up, my immediate, the first thing that happened was it hit my high of day momentum scanner. So it hit this scanner right here. Now, if we go back, it's going to take a second to scroll back, but I'll start scrolling back and we'll get back there in a second. So it hits the scanner, and as soon as a stock hits my scanner, I'm doing my sort of due diligence, and I'm asking myself, do I know this stock? Am I familiar with the ticker? Do I like the price? And so on and so forth. So it first hits, and the price at that time was around $5. So I'm looking at it and I'm thinking, okay, it's a $5 stock. That's when the price that I've done well on based on my metrics. The float on this is 594,000 shares. That's a pretty low float. It's a biotech stock. I always do well. I tend to do especially well on biotech stocks. I don't always make money on them, but that's the sector that I tend to do better on in general. And I knew that it had news. So now if we jump back onto our slide deck, let's look at some of the other criteria. The stock was up 30% on the day because the second that news came out, immediately it started squeezing. And so by the time I saw it, it was already up 25, 30%. And it's okay if I'm not the very first person to see breaking news, because if you were the very first person to see breaking news, you wouldn't know what to do with it. You wouldn't know if this is even good news or bad news. I always wait for other traders to react. And then if the stock starts moving up, I'm like, okay, people like it, I'm going to jump in. So it has to start moving. There has to be, generally speaking, a news event that's moving the stock higher. And I do better when the price is between 3 and 20. Now, there are going to be some days where the leading percentage gainer in the market, the most obvious stock in the market, one of the top 5, or all of the top 5 are 20 cents a share. They're cheap stocks, or they're $50 a share. They're too expensive. And if that's the case, I'm probably not going to have a good trade on that particular day. I know my sweet spot. And so if, unfortunately, for whatever reason, there aren't stocks that fit within my sweet spot, then I just kind of have to acknowledge that. I have to say, all right, that's the case for today. It's not ideal. It is what it is. And I'll, just have to be today a bit more patient and wait for tomorrow. Number 4, the stock should have 5 times higher volume today than its average. And that's really important because when a stock has much higher volume than average, it indicates that something really special is happening. So let's look at PRTG. PRTG right now is up 100%. It's $6.59. It's got 20 million shares of volume with a 600,000 share float. and its relative volume is 2,000 times higher than average. 2,000 times higher than average is a really big deal. I mean, stocks don't have 2,000 times higher volume just out of nowhere. Why would it have 2,000 times higher volume? Because there's news. That's the way it works. So you can see as I'm scrolling back here, these are all the different stocks that hit my scanners this morning. And every time a stock hits my scanner, I do my due diligence on it. I ask myself, what's the price? What's the float? What's the catalyst? Does this stock have a reason to move higher? And then what's the chart look like? So now we're getting back here to right around 7 a.m. So it first hit the small cap scanner at $7.16, and it would have hit the running up scanner down here probably a little earlier. This scanner has a slightly lower threshold for a couple of the filters. So when it first hit here, the biggest issue was that the volume was light. That was the biggest problem. But it had news, and it did make a nice move. It went up to about 8, pulled back, popped up to 9, pulled back. But it wasn't really easy to trade in this first area because, unfortunately, it didn't have enough volume. So the really clean trades didn't come until a little bit later. And that's not totally uncommon. Now, if we go back to our slide deck, we have 4 criteria for demand, and then we have 1 criteria that references supply. So what essentially we need in order for the MACD crossover to work is a stock that is likely to have an extreme imbalance between supply and demand. That's what allows it to be one of the top 5 biggest percentage gainers in the entire market today. And if we don't have that, it's not going to happen. So if I jump back onto the whiteboard, where's my eraser? There it is. So if we jump back onto the whiteboard, let me just give you an example. Let's say we have a stock that has 1 million shares of volume. Well, let's just use this as an example. So today we've got this stock, it's got 20 million shares of volume, and the float is approximately 500,000 shares. So this is volume and float, and now we're gonna do change, rate of change on the day. So it's currently up 100% right now, although it was up, I think it peaked at 200. So we'll put the peak at 200%. All right, so now let's just say, what would have happened, just sort of thinking this through, if we had had the same 20 million shares of volume, but the float was 5 million shares. Instead of 500,000 shares, it was 10 times higher, it was 5 million shares. I would predict that probably the stock would only be up like 20%. It would be up, but it wouldn't be up a lot. What if the stock had 50 million shares of volume? Sorry, 50 million share float and 20 million shares of volume. Well, the problem here is it might not be up very much at all, because what happens here is the float references the total number of shares available to trade. So before a stock pops up and hits news, there's already 500,000 shares that are available to trade. That means there's 500,000 shares that people currently own. So when the stock is up 200% in one day, what are those people going to do? They're going to sell. Naturally, they're going to want to sell. But here's the thing. Because there's so much more volume than there are shares available, those people can easily sell, but there's other people clamoring to buy because this thing is moving quickly. So it almost becomes a self-fulfilling prophecy. When you have a stock with a lot more shares, or even this many shares, unfortunately, you've got a lot of people, if it was up 200%, that would want to sell. So in order for all of those people to sell, you would need like 200 million shares of volume. Now, if we actually went there, if we said, well, what if this was 5 million shares, but we had 200 million shares of volume? Maybe we could get up to 200% on the day, right? Now, you're not going to get 2 billion shares of volume. It's not, at a certain point, it's just not realistic. You don't see that kind of volume. I've seen stocks trade over 1 billion shares in one day, but not much higher than that, and those are usually lower priced stocks. So what we know in this relationship is that float references the supply, and volume is an indicator of how much demand there is. Now, there's a few other things that we have to be aware of, which is whether or not the company may be considering doing a secondary offering, a direct offering on the open market, which a company might do to raise money if they needed to. So there are some scenarios that can affect how much a stock will go up, even when the float is low and the volume is pretty high and you think it should go up a lot. There are times where it won't. But generally speaking, this is the profile that I look for. And so I'm using the scanners to search the market in real time for stocks that meet these criteria. And so today, when I grabbed this screenshot, which was around 9:25 a.m., these were our top 4 or 5 stocks. PRTG was the leading gainer at that time at about 178% on the day, which is incredible. 15 million shares of volume with 600,000 shares, a little over 500,000 shares available to trade. So that's the float. So this traded a solid 30 times the float. We would say that float was a 30 times float rotation, the ratio of volume to float. The relative volume at that time was substantially higher. The relative volume has come down because by this point in the day, it hasn't been able to sustain the level of volume to keep it that high. But it doesn't matter because my minimum criteria is 5, and it's still way, way above that. So if you're thinking about doing a trade for a MACD crossover, it's very important that the stock is obvious. Lots of people need to be watching it. If people are watching it, the patterns are more likely to resolve the way you would expect it. So now let's look at this example on PRTG. So PRTG had this big squeeze up on very light volume. It pulls back, it pops a little higher, which was nice. I got a little trade in there. And then it kind of dips down and is going sideways for a while. So through this area, it's going sideways. And then all of a sudden, what happens? Boom, it squeezes right there. So what I want to do is I want to really dissect that entry and that pattern. And we're going to go on to the 10-second time frame. So one of the things that's nice about these charts that we've built out here with Day Trade Dash, we partnered with TradingView. So we use TradingView. So we use their engine, but we connected it to our own market data, and we filter out the data to make sure the charts are clean. So right here, this was a really important spot. So I'm going to remove this line for 1 second. So on the 10-second chart, so there are a couple things that were happening. So first, let's go on to the 1-minute chart and just look at the volume weighted average price. So we had the VWAP, and what we know is that the stock had gone below, had come back up, gone below, come back up, and the volume profile was higher volume on these green candles when it was bouncing back up. What I was doing was I was waiting for the crossover because there's a setup where we get this curling pattern where a stock has been strong, which is what gets so many eyes on it, but is currently kind of pulling back, going sideways. It's a little choppy. And then we're waiting for that curl. So this gave it in kind of like one quick punch. Sometimes it's a little bit of a slower ascension to a curl, but in this case, it was kind of like a big punch. And that's fine. So anyways, I'm watching it and I'm thinking to myself, what are the lines in the sand on this stock? You know, I was getting dialed in. I was thinking, I think this is going to give me more opportunities. And the reason I think it's going to give me more opportunities is because the stock is already shown, I'm already green on it before this trade. But it was showing that it could move quickly. And so what I know is that stocks that have a float of 594,000 shares, if shorts are too aggressive on them, they can really get buried. Because what can happen is during these periods of sideways consolidation, when the stock is sort of just hanging out, people will just be shorting and shorting and shorting, trying to anticipate the break of VWAP, where the stock breaks down. And so you can see you did get that breakdown here, and it was on higher volume. So people, as it broke down, they were adding to that position. You get that breakdown, it curls back up, and then all of a sudden they're like, uh-oh, this isn't working. So you get this area here where people are shorting, they want it to fail. And a lot of these short sellers are thinking, well, look, the stock's up 177%. It's extended. It's due for a pullback. That's what they're thinking. But unfortunately, well, these can go up a lot more than you might expect. And that's what happened here. So I was watching this and I was kind of thinking to myself, all right, well, where does it need to break in order to get exciting? And I thought it would be the high of this double top right here. So you see how it came up to 792 once and then twice. Now, both times when it came up there, the MACD was well in the negative. This had sold off and bounced back up. So I wasn't going to buy, I wouldn't have bought up here. It was too extended. It came back down again and then came back up. But this created this double top where it just sold off too much and then came back up. So it was like not safe. And then here it pulled back, but it didn't go lower. So the next thing I did was I said, well, if we have some ascending support right here, this could be a support level, right? And it's crazy because this basically ties back to right here. It bounced here, here, and it comes down to it like right here. So you've got the support of the volume weighted average price. You've got the support of the ascending support line. You've got the 9 EMA, the 20 EMA, all kind of right here. And so I was just watching the level 2. And so with the level 2 up, what I'm looking at is the orders that are on the bid, the orders that are on the offer. Now, the chart is really important. The chart is giving us all of the historical context. So the chart is looking backwards at what's already happened. But how do we know what's going to happen next? So I use the level 2 to try to make a prediction of what's going to happen next in conjunction with the chart. I'm using both of them side by side. The chart is sort of telling me what happened, but is helpful because I can tell how much the stock has gone up, how much it went down, where it's holding, is it starting to curl. But then when I look at the actual level 2, I look at the level 2, and what this tells me is if there are actually big buyers or if there's big sellers. So what I noticed was an absence of any big sellers up here around 8. Now, if there had been, let's say, a 50,000 share seller on the level 2 right here at 8, that would have blocked the stock from breaking out. And that would have explained why it double topped once and then double topped a second time, because right up here, there was a big seller. But that was not the case. Now, I looked for any big buyers, and I didn't see any big buyers, nothing really notable, but I didn't see any big sellers, and that felt important. And so I'm watching the level 2, and it was right about this area, 750 by 760. And I saw these last 2 candles peaked at about 770. This one was 768, this was 769. And this previous candle had popped up to 779, but then dipped down. And I noticed right here that we had bottoming tails. What does a bottoming tail signify? So when we have a candle, and we'll just do, actually I should do it in green. So we've got a candle right here. Let's just say we have a stock that's, it doesn't matter. So a doji candle, the price opens and closes at the same level, right? Now a shooting star has the body here and then has a topping tail. So we often see a shooting star in the context of a stock that's been moving up, and this is an indicator that's beginning to reverse. This topping tail is bearish because while the price squeezed up, sellers pulled it back down, and by the end of the candle, it closed as just a topping tail. Each candle, of course, communicates 4 pieces of information: the open, the close, the high, and in this case, the low. Sometimes you'll have a candle where the open and close are the same price, or where the high is the same price, or the low is the same price, etc. So that's not totally uncommon. But every candle has a minimum of 2 data points that create the shape. The open and the close have to create the shape. And then if there is a high or a low, then that's that. So when we, on the other hand, have a stock that moved up nicely, so you've got a couple of nice big green candles, and then we get a little bit of a pullback right down here, and then we get this bottoming tail. What does that bottoming tail tell us? That bottoming tail tells us that sellers, although they brought the price down, they also pulled it back up. So a bottoming tail is bullish, a topping tail is bearish. So that's something that's important to remember. So here I'm seeing these bottoming tails. And what that's telling me is that the stock is dipping. Maybe sellers are trying to make it drop. Or sometimes it's called a bear raid, where sellers just try to kind of like hammer a stock. And they'll do that to defend against a certain level. They don't want a candle to close green. So at the end of the candle period, they'll sell a bunch to try to get it to close red. They want the candle to break below VWAP. So they'll sell a bunch to try to, force it to break down, which would then support the position that they're in. And so each time it dips down, it gets bought right back up. It bounces right back up. And I'm thinking, all right, this feels to me like it's not dying. And so then all of a sudden here, it explodes. And so what happened was I started buying in this candle. I bought my first entry. Well, let's see, I'm gonna have to go. So what was the timestamp on this? So this was at 7:42. All right, so 7:42 a.m. So if we go back to 7:42, it's gonna be a little bit before that. So as it started to pull away right there, I added at 778. That was my first entry. And it was as it was already starting to perk up right here, I added right there at 780, 778. I added at 792. So as it broke this level, I added at $8, and I added as it came up to 820. So I had 15,000 shares right down in here. And then it immediately went up to 880, and I added for the break of 9. It breaks 9, and this thing squeezes all the way up to a high of $9.90. Kind of unbelievable. And so now I'm in full size and I'm up over $2 a share. And I'm thinking, all right, it's game time. Is this going to keep going? So I actually added right there, and it goes all the way up to a high of $10.61. Then it pulled back. I booked my profit. I added back right here at 10.50. And this was a trade to anticipate a new high. And unfortunately, it rejected. it hit a high of 1126 and then it flushed back down. And there wasn't really any indicator that that would happen. It became a rejection with a high volume red candle, but there wasn't an indicator to me really that that was going to happen. This felt like kind of a proper pullback just after the fresh breakout. Now, I still made money on it because I bought down here for the first candle to make a new high and then added at 1050 and took profit at 11. So it was still a green trade, but it wasn't as good as I would have liked. So then it ends up pulling back a little bit, and I thought, well, now at this point, it's getting a little choppy. The spreads are a little bit bigger. It has to hold not 880, 890, around $9, which was the previous high. So it did come back down to that level. It bounced off of it. It rallied back up and then comes back down to this ascending support level from earlier, sort of holds in that area, and then it's below it. And now we're kind of back to chop. And it's like, all right, I think the easiest trades are done. So that was PRTG. Now, I had another stock I trade today, which was MNTS, NUKK, and SIDU. So now I'm going to move this out. I'll just hide it here for a second. So let's jump back onto here. So now let's look at NUKK. This one gave us a sort of similar setup. So we had this big rally right here, all the way up to, I can't remember the price. When I put this on, you can't see the price. Anyways, it comes back down, and then it starts to curl back up. And look right here, you get that big crossover. So you get that big crossover, and this thing goes from $2.30 all the way up to almost $4 a share. Really impressive. Now, on this one, you got this initial pop to 380. Then it pulls back right here. And if you miss that first pop, you could have still bought this pullback. So that's kind of the second best opportunity is if you miss the first pop to watch the first pullback. So here's MNTS, pops up. If you miss that pop, you're waiting for the crossover. Here you get the crossover and a retest of the highs and all the way up to just about 12. This was a little lighter volume, so this was a little trickier, but I did trade it. So let's back out of this for 1 second. So I'm going to put this over here, and I want to show you something. Let's see. So, well, actually, two things. So let me jump back into here. Let me show you indicators for a false breakout, because I think this is relevant. So if we're watching the pattern form and we have a high volume red candle, high volume red candles can indicate that there's people selling, there's people dumping. And so that can be an indicator of a potential false breakout. We didn't have that really on PRTG, but that's something to be on the lookout for. Large topping tails. Those large topping tails, they are bearish. So when we see those, that can be a problem. Number 3, if the stock is not obvious, you're not going to get good follow through on it. And that was actually a little bit of a problem today because we had so many different stocks that were moving today, we had dispersed attention. So I was a little bit concerned about whether or not we'd be able to figure out which stock was actually obvious. And although we did get some good trades, it was a little bit tricky. If there are large sell orders on the level 2, right, then those large orders on the level 2 are telling us the stock is not going to go up to this level. That chart is never going to form because there's a big seller blocking the way, right? So imagine you've got a stock where you have this nice move up, nice move up, nice move up, a little pullback here, whatever, no big deal. And you're watching maybe a little bottoming tail here. You're watching for that first candle to make a new high right here. And you're like, yeah, we're looking for this move all the way back to the high. But on the level 2, maybe you take this entry here. And then on the level 2 right here, there's a 1 million share seller. That sell order is so big that it's now completely unrealistic to expect that this level is going to break, right? It's just too big of a seller. So it's not going to happen. So now you're not going to get that resolution through the high. And in fact, what you probably are going to get is a rejection back down as people who see that seller realize, I got to bail on this thing. It's not going to give me that big move that I wanted. It's just not going to happen. All right. So large sell orders on the level 2, pegged orders on the level 2, that can also be a problem. That indicates people are trying to sell and have the strategy to use a pegged order, which is a little more sophisticated. So it probably means they have a larger position. And then usually if a stock retraces more than 50% of the move, I'm going to hold off on it. But sometimes we can get a curl where a MACD crossover, even in spite of that. But it's not as common. So now let me throw something else at you. So let's say we had the MACD crossover, as you kind of had here. This was a positive crossover up here. Then it's negative. It goes negative deeper. And then it kind of rallies right here off the low. All right, so you get a little bounce off the low, and that's kind of sideways. If you miss the initial crossover, you can always look at buying the first pullback. And that's when we're back to looking at this chart and saying, okay, look, MACD is open, high volume on the buy side, light volume on the sell side. This is a setup that I'm going to want to trade. And now you're just buying the first pullbacks right here. You're buying this dip right here. You're maybe buying that dip right there. So that honestly is my favorite way to trade these, is to trade the front side of the move when the MACD is open, buying these pullbacks right down here, buying the dips and then selling into the breakouts. Here you've got, again, MACD going slightly negative, but then you get that crossover kind of right here, and boom, that gives you that nice swing higher. So paying really close attention to when we're setting up for a potential crossover really makes a lot of sense. Now, this is my micro pullback strategy. So here, this is a nice crossover. So this one popped up, it pulled back, MACD was negative, and then you get that crossover right there. So that would have been an early entry, but if you miss that early entry, that's okay. You can wait for the next pullback. So this is the first pullback following that fresh move, and this goes from 450 to 7. In fact, that's maybe, arguably, an even cleaner setup because it was very easy to understand, your risk was manageable. So this is a setup that I just love to trade. Now, it's important when we trade that setup that we're making sure we're trading stocks that are obvious. They're up, in this case, 245% on the day, and I'm okay with that. There's no such thing for me as a stock being up too much on the day. If it's up a lot, if it's the number 1, number 2, number 3 leading gainer, there's a lot of eyes on it. People are focused on it, and they're gonna expect that if this stock has already made this big of a move, it could keep going. And they're not wrong. That's often what ends up happening. So in the description, there's 2 links. Well, actually, there's 1 link and there's 2 downloads. The first is for the stock selection PDF. And the second download that's on that page is for my micro pullback strategy. That's a PDF that you can print out as a resource and you can use it in your own trading. And what I encourage you to do is to put the MACD on your chart and to watch the right stocks. Watch the patterns that the MACD is forming when you've got the right type of stock to trade. You'll see these big sweeping crossovers, and the cleanest ones are almost always in the beginning of the move. So PRTG, you had these sort of big crossovers here, right in here, right in here. This is where you've got these really big exaggerated moves. And you know what? This is a spot here where some traders might have tried to buy right here, but then you look down and it's like, is that gonna work? The MACD is definitely negative. So that's not gonna work. And of course you got this topping tail, which also tells us, no, we probably shouldn't trust that. So it's like multiple levels of risk on this. Now let's see. Oh, look at this. So out of the corner of my eye, I see NUKK actually rally back up. So let's pull this one up for a second. So while I was just teaching this class, NUKK, so this one ended up rallying back up again. And these crossovers are really nice too. So look at this crossover right there. That was right in this area. That was a really nice one. So you get that crossover right there. So if we back this up to right in here, so all of a sudden the MACD is negative. Now, the only thing I would say is that unfortunately on this one, you've got this red candle here. I don't like that red candle. It's a red candle, but it's got a big topping tail. That's not great. But all of a sudden there, now it's ripping through the highs, through 660, and then pull back up to 7, pull back up to 8, pull back up to 9, up to 1047, and currently halted on a circuit breaker. Now, a move from 5 to 10 is fantastic. I mean, there's nothing to complain about there. I will say that we see big moves like this during regular trading hours and the stocks don't halt. So a move like this, you don't have a halt. So those are particularly clean, but really can't complain about a setup like that. That's really nice. Okay, so big picture, let's say we have a stock, boom, all of a sudden pops up right here. So you get that big green candle. The moment the stock pops up, what's happening? It's going to be hitting our high day momentum scanner so long as it meets all 5 criteria of stock selection. It should be up 30%. It should be moving fast. There should be a news catalyst that's creating that momentum. And if the stock is priced between 2 and 20 approximately and has a float of less than 5 million shares, it's going to be a lot more interesting to retail traders like you and I. Because we're going to look at that and we're going to be like, this is the type of stock that can make a big move. So the stock first hits the scanner, and in that moment, when we pull up the chart, what's the position of the MACD? Well, because the stock has immediately started moving up, the moving averages are immediately doing what? They're diverging. So the 12 is moving apart from the 26, which is the fast and then the slow. So right away, the MACD is going to be wide open. You're getting that first pop up, and then you get a little red candle. Now that's fine. We look for those red candles so we can manage our risk. And this is where we're gonna buy first entry right down here. Now that's the pattern that we like. This is our micro pullback. So that's what I'm trading every single day, first trade on these stocks. Now, of course, I'm always gonna check to make sure on the level 2, right, level 2 data, that there's not like a huge seller kind of blocking the way right there. If all of a sudden there's a big seller, then that's gonna tell me the trade's not gonna work. But as long as that's not the case, then I'm gonna take that first trade. So if we look at PRTG, for instance, PRTG, when it first started to pull away this morning, initially it pops up, it hits our scanner. Well, we'll do the 1 minute chart. So initially it pops up, it hits the scanner, and what's the position of the MACD? Of course, it's wide open, right? The MACD down here, wide open, high volume green candles. We get a pullback here, and this pullback down here is enough for me to buy this dip. Now, I actually take that dip trade. It didn't hold, but because I bought the first candle to make a new high, it was still a green trade. It dips down, it rejects, and then when it comes back up and can hold at 8, I get back in because now it's proving it can hold the top of that candle, and that gave another trade right there up to 880. That was our peak up to 880. So between those two trades, I was able to lock up some profit trading just the first pullback. All right, that's the micro pullback. Now, micro pullbacks can take a couple of different forms. Sometimes we have a very well-established micro pullback like this, where you've got, 2 red candles. And this, by the way, it can be on the 1 minute chart, but it can even be on the 10-second chart. The 10-second chart can be a micro pullback, like a really fast one. So let's look at, for example, when PRTG finally broke through the high, when we had this big MACD crossover. So let's just say that you traded right in this area, the way I did. That was the first pullback following the breakout. MACD was open, and then the MACD crosses over here. So we're like, nope, don't care about it all through here. So essentially, if we're using the MACD, we're gonna say from this point, basically when the MACD is crossing, all the way to here, we don't care about it. Now, would we have lost money? Would we have lost and missed out an opportunity by not trading this range? No, we wouldn't have. This was a window to trade. This is a window to trade. This area, it's sideways, it's choppy. So actually it'd be kind of almost helpful if we put this overlay right on the chart when the MACD is negative, just to remind ourselves, like, this is a red light. Don't trade it here. So anyways, the MACD finally, we get the crossover down here. It pops up, but let's say you missed that pop. You weren't looking for a second, you missed it, and now you're like, oh my gosh, the MACD's finally just opened, and this is moving back up. What do? If you miss the crossover, you miss that first timing, then you look for the micro pullback. You're pulling up the level 2, and you're buying right in this area, this dip, for the next leg higher. And odds are strong that it's going to work. Why are the odds strong that it's going to work? Because this is the first pullback on a strong stock. There's lots of people watching it who are excited because this is a stock that's already proven how quickly it can move, right? So it's the type of stock that can really start to open up, and that's when I get really excited. And again, this is just understanding the psychology here. So once you're in the trade, your exit indicators, high volume red candle, large topping tail, stock's not obvious. Obviously, we got to get out if it is no longer obvious. Now, we've already talked about this, but just to reiterate, a stock can be obvious when you trade it, and then another stock can come out with breaking news while you're in the trade, and that stock becomes more obvious. Traders can be very fickle. They'll jump from stock to stock. So you got to be careful that you're not holding a stock that everyone's kind of losing interest in as something more exciting has come up, on the scanners. And then naturally, if the MACD crosses back into the negative on a pullback, the price breaks below the 90 MA on a pullback, or we see large sellers or pegged orders. Now, one of the biggest challenges that traders have is not necessarily understanding, how to read charts. That's not usually the hard part. Understanding how to read charts, it's fairly straightforward. Once you learn the language, you can understand the candlestick charts. The hard part for most traders is having the discipline to follow the rules of your strategy and to be patient. It is so hard for most beginner traders to be patient, and I get it. It's hard for me to be patient. I look at some of the younger traders that are in our community, and I see them like they're so trigger happy. They're jumping on everything that's moving. And I remember when I was in that place, how hard it was for me to like throttle back and slow down. But here's how I want to kind of inspire you. Success in trading requires creating a positive feedback loop. This is about creating the mindset for success. And you know what it starts with? It starts by focusing on A+ quality stocks. When you focus on trading the best quality stocks in the first place, by default, your accuracy will be higher. And when your accuracy is higher, you have fewer losers, which means you're going to have an improved profit-loss ratio, and that's going to create a calendar of consistency where you've got lots of green days, and that creates self-confidence. When you're confident, you increase the quantity of trades, you increase your share size, the dollar amount of trades, and that increases your profitability. So this becomes a positive feedback loop, and we can all tie it back to focusing on quality, A quality stocks. So when we look at the stocks from today that were giving big moves, and you look at these entries and the setups, it's important that you recognize that these were the right type of stocks to trade. This didn't work just because the MACD crossed over. This worked, the MACD crossover signaled a buy because this was already a stock people were so excited about. NUKK right now is up, it's now up 900%. 900%, this is insane. So this is a stock that already made a crazy move, it pulled back, and then when it came back up for a second attempt, you got the MACD crossover, traders went back in it. Why would they go back in it? Because this is a stock that has already shown so much potential, people want to keep trading it, and they're thinking if it can go from 6 to 8, who says it can't go from 8 to 10? How do you know it can't go from 10 to 12, 10 to 14? How do you know it can't go from 14 to 18, 14 to 20? And so people will keep trading it as it's moving higher. But you got to be careful because once traders see a big red flag, maybe it could come in the form of a big seller or a high volume rejection, they could abandon the stock very quickly. And when all of a sudden people abandon it, that's when you get this rapid drop in price. So being a successful trader means understanding the psychology in the market that's driving the price action. And in a lot of cases, it's fear of missing out, FOMO. It's greed, people wanting to make money. It's fear of loss, people shorting who are then covering, they're afraid that they're gonna lose. They take a panic cover. So there's so many emotions in the market, and those all end up being reflected in the patterns that we see every single day. So that's where I feel like the more you immerse yourself in the community and the culture of trading, the better you get at learning how to trade, the better you'll get at really becoming fluent in this language. And the better you'll get at being able to make the prediction of, okay, I see what's happening now, what's gonna happen next? So right now, at this very moment, we look at PRTG, and although you could say the MACD might be coming close to a crossover, and it might be, there could be something there potentially, this certainly had a big swing up, a pretty big reversal coming back down. But if you get that crossover right there, that actually, see, look at that. See, as traders start to see that, they start to buy into it. And this has enough volatility, plus the bottoming tail, where all of a sudden people start piling in really quickly. Now, again, this is trading during a time of day where you're gonna have circuit breaker halts, and those effectively slow down the momentum. They prevent really the most epic of parabolic squeezes. Now, what about this trade on NUKK right now? This one already had some big MACD swings here and here, back to negative, back to positive here, back to negative here. So we're kind of in a little area from this area here where there's not clear conviction. You also have declining volume. So at this point, unfortunately, you probably need to wait for the 5-minute pattern to form. So this is where we also start kind of going back and forth between our 1 minute. Well, if the 1 minute doesn't look good, we got to wait. Let's check the 5-minute. See, it's kind of extended. Down in here, it pulled back to support, right? But then now it's kind of extended way up here. So we always like to find that multi-time frame alignment, and you're looking for the same patterns. But here's the thing, if you have a fantastic pattern on the daily, it typically won't work because you need a catalyst to bring in the volume to make that pattern work. A good pattern on the 5-minute can work if the 1 minute's not great because there's more people that use the 5-minute chart than the 1 minute. A really good 1 minute pattern usually will not override a terrible 5-minute chart. So, you don't need to have a great 5-minute chart for the 1 minute to work, but you can't have a big, huge sell signal on the 5-minute chart and expect the 5-minute to work. That typically isn't going to be the case. So we start high level, but then we get zoomed in. And when we've got multiple time frames all aligning, that's when things get really exciting. So I said at the end of this episode, I would give you guys some recommended reading. So let me go ahead and do that. So over here on the whiteboard, I'm going to recommend this book, The Power of Knowing When to Walk Away, Quit by Annie Duke. I think this is really important for traders. And this is another book she wrote, Thinking in Bets, Making Smart Decisions When You Don't Have All the Facts. These both go hand in hand with being a full-time trader. So I really encourage you guys to check those out. And if you haven't checked out my book, I actually have a book right here, How to Day Trade the Plain Truth. It's on Amazon, and you can download. You can also do an audiobook. In fact, I will put a link, and this is another book, The Happiness Advantage by Sean Acor. So I already mentioned in the description and pinned at the top of the comments is a link where you can download my my stock selection PDF. There's also a link where you can download from that same page my micro pullback strategy PDF. So you can download both of those resources and print them out. Inside the description, if you open it up, you'll see a link where you can check out my free day trading course. It's about a 90-minute long course that teaches you the basics of my strategy. And at the end of that class, everyone can get the audiobook of how to day trade. So you guys should check that out. Or it's the ebook. It's the ebook of how to day trade. So make sure you guys check that out. And if you want to do a 2-week trial, you can always check that out as well and watch over my shoulder and see what it's like to be trading in this community every single day. Thank you guys as always for tuning in. I hope you enjoyed this episode, and we've had a wild market today. We've got stock up over 100%. The second one's up 200%. Third one's up 100%. I can't wait to see what tomorrow has in store for us. So thank you for tuning in. And a reminder as always, manage your risk, take it slow. And I'll see you guys back here. I'll be live streaming for Warrior Pro members tomorrow morning at 7 a.m.